Welcome to Cherry Bekaert's GovCon podcast, where we discuss current government contracting trends, compliance matters, and best practices to guide federal contractors forward. My name is Eric Poppe. I'm a director with Cherry Bekaert's Government Contract Services Group. And with me today is Craig Hunter from our audit practice. Craig, thanks for joining me today.
Thank you, Eric. Hi, everyone. My name is Craig Hunter, audit partner here at Cherry Bekaert, serving and servicing government contractors and technology clients, many of which are small and have entered into these JV agreements. So I look forward to sharing today.
Yeah, and Craig, just like you mentioned a moment ago, today we are going to be continuing our discussion on the 8A program and mentor-protégé agreements, which is now the All-Small Mentor-Protégé Program. And we're going to talk about, some of those basic blocking and tackling questions, nuts and bolts, whatever phrase you want to use, about, just how do you actually handle the accounting piece when you are entering into one of these JV agreements and you're part of a mentor-protégé arrangement. And we get a lot of questions from our clients all the time. They're like, hey, we have a contract, we have this JV. It's an awesome opportunity for us to go after new business. We won this award at the JV level. How do we actually do the accounting for? Like, what's the financial reporting implications? How do we do the actual cost reporting? How do we handle the indirect rates? So today we wanted to talk a little bit about those topics. So just as a refresh for those who maybe did not listen to our previous podcast, today, that we're talking again around JV accounting, specifically around the SBA Mentor-Protégé Program, which back in November of 2020, the 8A Mentor-Protégé Program turned into the All-Small Mentor-Protégé Program. And the overarching goal of this is really to help establish and new contracting opportunities for the government. And help to have a better supply base for federal procurement. And in that way, allowing large businesses to partner with small businesses to create these JV arrangements and go after a certain amount of work. And the goal of the Mentor-Protégé Program, it's kind of in the title, is for the large business to help provide some services to the protege with guidance on internal business and management systems, accounting, marketing, helping with financial assistance maybe, and maybe some equity investments and owning a piece of the actual protege up to 40%, helping with business development, helping with maybe human resources and G&A type of activities, but really, helping to establish this protege, help prop them up, give them back office support when needed. And with that, the protege reports annually and gives progress reports to SBA. This, I did not mention, that the mentor-protege agreement has to be approved by SBA. There's an annual check-in, so it is a great program. But again, the JV arrangement between the mentor and the protege, that entity is going after contracts, and it's a great way to win set-aside contracts for the mentor. But again, we always get questions about, we have this contracting opportunity, we won the contract at the JV level. How do we handle this? So, Craig, just to start us off, how are these JV arrangements usually set up?
Right. Thanks, Eric. So, starting at the beginning, setting up the joint venture is always a separate legal entity together with its own organizational documents, operating agreement and such. And very importantly, for an entity to be a joint venture, there must be the existence of joint control. And that's defined as decisions regarding the financing, development, sale, operations, business have to require the approval of two or more of the owners. And so no single investor can have the unilateral ability to cast a deciding vote and take control of the entity. So what we always recommend and suggest for our clients is you build in arbitration procedures as part of the operating agreement. So if there's ever a deadlock of voting, there's some ability to go to arbitration. And that allows this to be a joint venture as defined, which is important, because if it's not a joint venture and your shareholding is greater than 50%, you're likely going to have to consolidate, which is really something that you don't need to do. So it's have to be mindful of that up front in setting these up to make sure that you put yourself in the best position to account for them in the best way. So joint ventures are typically unpopulated, and the SBA actually requires an unpopulated JV. And simply put, an unpopulated JV is an entity without its own employees. So really all the costs to fulfill its obligations to the customer come from each of the two venturers. So at this point, if we think about it, we've got company A and company B that each have a share in the joint venture, and you've got this JV that is set up. So Eric, at this point, how do the day-to-day accounting flow between those three entities?
That's a great question, and I think you need to remember that the contract is awarded to the JV, and so the actual billing upstream to the government goes from the JV to the government. So company A and company B, the mentor and the protege, they will be billing the JV itself. And there also might be some small administrative fees and such, or allocation of indirects based off of if it's a special allocation that might be going to the JV. But in the end, the partners are billing the JV. JV is then taking that cost and billing to the contract terms up to the government. Now, there are multiple considerations with this. You need to identify where the profit's going to lie. Is it going to be at the JV level? Is there going to be some also at the partner level? But in the end, you are typically billing the JV then billing the government to the terms and conditions. Now, it can get a little bit hairy where you need to, in writing, and this is kind of a best practice, Craig, that you and I have talked about, is get in writing how you're going to be handling the invoicing between the partners to the JV, and what type of billing method it's going to be. Is it going to be at cost? There's indirects that are applied, and it can really vary on then how you bill the government, because those two might not be the same. You might not be billing the government in the same manner that the partners are billing the JV. So those are all some items to consider when looking at the actual billing process to the JV. Now, a lot of times, company A billing the JV would be billing. They'll just set up a separate project for that JV, and you would have in your accounting records for company A direct costs associated with that project, your associated indirects, billing that over. And from a JV perspective, those direct costs coming in would then be billed to the government, of course, but we've seen companies treat that as cost of goods sold, subcontractor costs. They're typically, though, it is a limited set of accounts there at that JV side. Most companies that we look at have a separate QuickBooks set up for the JV accounting. It's managed by one of the partners, but that's, in short, partners bill the JV, JV then bills the government. Craig, do you have anything to add?
Yeah, while there's nothing prescribed, one needs to look at the results of the various billings. So if the companies bill their cost to the JV and the JV bills to the government, the JV will start to accumulate the profits at the JV level. And at this point, from a cash flow point of view, those profits and the cash, until they're distributed, remains in the JV. If each company were to bill their direct labor plus the allocation of indirects plus a profit portion, they would essentially be getting that cash flow on a more regular and earlier basis. So that's just something to be mindful of as we're looking at the whole setup. And that really, once we bill, and at the end of a given year or period, the JV will likely have, and it's probably a good best practice to leave some profit in the JV just for some incidentals of expenses that may be JV specific, as opposed to the expenses that each of the companies are bearing.
And one thing to add to consider with all of this is the requirement that the protege performs 40% of the work done by the JV. So there are requirements about how much you can subcontract, but in the end, the protege has to do 40% of the work performed by the JV. So that's just another thing to consider. As you are putting together these JV arrangements, which can last up to 6 years in the contract length. So this is someone that you'll be working with for a long time.
So make sure that you've done your homework, and it's someone that has a similar strategy as yourself, because like Eric says, it's a business partner and hopefully a long relationship. At the end of a period, once the JV has closes its book, the way in which the various companies account for this is actually very simple. The accounting standard is ASC 321 that governs the accounting for joint ventures, and that is what we call the equity method. And under this equity method, each of the venturers will account for their portion of the net income as a single line item on their income statement, and the debit side of that would go to the asset called the investment in joint venture on the balance sheet. So that's the single entry that would happen at the end of every period. If the distribution was made from the JV, then it would be a debit to cash and a credit to the asset account on the balance sheet of each of the venturers. So the accounting for JVs is fairly straightforward from the company level, as long as it's all set up correctly to start with.
So, I think that's a good point, because you have different perspectives that we're working here: financial reporting perspective, cost accounting and accumulation and allocation of costs. So how the partners are billing the JV, and from that standpoint, there might be cost accounting implications if one of the partners is CAS covered, and that would be CAS 403, the allocation of home office costs, because this JV could be considered a segment, and also the allocation of G&A costs, CAS 410, and how does that get allocated over. There is a little bit of wiggle room of special allocations, but you have to disclose that and show how the JV is pulling that cost. So there are some other items to consider. I think, Craig, then you have the billing perspective, JV to the government, and that need to be billed at the contract terms and conditions. But a lot of this can really vary on the contract types, and what is that contract type that the JV holds. We're seeing a lot of JVs now go after, and the partners go after these large IDIQs or GWACs, where you could have multiple contract types by CLINs or task orders that come through. So how do you handle the accounting? Some considerations with the accounting, typically, again, you see separate books of accounts, separate charts of accounts, or simple charts of accounts. The one best, we touched on this earlier, but really memorializing how the accounting and the other services are being handled and how they're being billed, I feel like is one of the biggest recommendations that we can have, and having set policies and procedures, because that's where a lot of, I feel like, companies that we talk to might get in trouble down the line, is not having those items memorialized.
Exactly. And, best practice, just, thorough documentation, getting all the legal documents in place, and really putting some strong governance controls in place. So between the companies, taking a good monthly look at the joint venture books and records and results, and really being very transparent with billing methodology and billing practices. We have seen, Eric's got a war story about, companies working on a handshake, right, Eric?
Yeah, so we've helped we have one of our clients has a JV, and they've been working with the JV has a contract and billing the government, and now it's gotten a little bit hairy between the two partners, and there was no there is no documentation to show what the partners, or how the partners were supposed to be billing the JV. And the rates have changed, and now the two companies are pulling legal involved. They're getting into he said, she said of the indirect rates, and it should have been this, but now it's that. And but it all comes down to documentation, governance, good policies, and really being able to support how you invoice the JV and then to the government. So it's definitely not the best situation, but good to learn from. On that note, Craig, I feel like we could talk for hours about the actual accounting, and even getting into tax considerations for these JVs. But I think we will cap it at that. I do appreciate everyone tuning in to Cherry Beckert's GovCon podcast, and please subscribe to wherever you get your podcasts to keep following. I know we'll have more topics on the 8A program and mentor-protege program and small businesses in general. So please tune in. Please reach out if you have any questions. And Craig, thanks for joining.
Thank you.